the bank's failure?
We had an office of the chief risk officer that was overseeing risk management for the institution.
Okay, can you also just explain to me the concept of safe space catch-ups? What was that in SVB? Safe space catch-ups? It's been widely reported that your bank spent enormous amounts of time with your executives promoting safe space catch-ups. It's basically a diversity, equity, inclusion endeavor to make people feel welcome in the bank.
Congressman, that does not ring a bell with me. I don't know what that would relate to.
Can you estimate how many of your senior risk officers were also leaders in your company-wide diversity, equity, inclusion program?
Congressman, I don't know the answer to that question.
It would appear that a lot of time was spent, your website, prior to it being shut down, had enormous amounts of emphasis on that, and it seems that there was a lot of time spent on things that do not cause banks to succeed and things that make people feel good, and I think that that was part of the problem. Moving on, some are proposing increased capital requirements going forward, and I'm going to ask each of you this question. Would increased capital requirements have avoided your bank from failing, Mr. Becker?
I can't comment on that because I don't know what the requirements would be in this structure.
If they were 50% higher, if they were 100% higher than the previous capital requirements. I mean, they're proposing 10%, but I mean...
I don't know the answer to that question, Congressman.
Mr. Shea, would increased capital requirements have caused your bank to not fail?
I don't think so. As one depositor I spoke to on Friday afternoon said, unless you have $1 of cash in your vault for every dollar, I have to move to a too-big-to-fail bank.
And Mr. Ruffler?
Similar, I would say that the capital requirements we have now are very strong, and I think any change that might be considered should consider the impact to regional banks and community banks, and be careful to not have a one-size-fits-all, because I grew up in a small town in Wisconsin. I know the importance of community banks, and you want to make sure they can continue to provide the service and support the communities because they're so integral.
I think we agree on that. Thank you. Mr. Chairman, I yield back.
Gentleman yields. The gentleman from Nevada, Mr. Horsford, is now recognized.
I thank the chairman and the ranking members for the hearing. I just have some very specific questions. So again, if you could respond with brevity. Mr. Becker, do you take any accountability for Silicon Valley Bank's failure? Yes or no?
Congressman, I was the CEO of the institution, so I'm responsible for Silicon Valley Bank.
Mr. Roffler, do you take any responsibility for First Republic Bank's failure?
As I said earlier, regardless of what caused this, I take responsibility for our clients and for our employees every day and making sure they're taken care of and supported.
Mr. Shea, do you take any responsibility for Signature Bank's failure?
As chairman, I believe that I fulfilled my responsibilities responsibly.
Well, what's very troubling about each of your responses and sitting here is the idea that your lack of governance and oversight and mismanagement has disrupted the entire regional bank ecosystem in our country. And as a result, our committee and other committees of jurisdiction are now having to step in to figure out what we can do to help protect small businesses and other depositors to make sure that their lives are not further impacted. So it's mind-boggling to me that you can't take full responsibility for your actions. Do you agree with GAO's statement that your bank's failure had to do with the poor governance and unsatisfactory risk management practices? Yes or no, Mr. Becker?
Congressman,
yes or no?
I take ownership for the decisions that were made.
Yes or no, do you agree with GAO's statement that it was poor governance and unsatisfactory risk management practices?
Congressman, I take responsibility for the decisions that I made.
That's a non-answer. Mr. Shea, do you disagree with GAO's statement that your bank's failure had to do with the poor governance and unsatisfactory risk management practices?
I can't speak for the regulators. I believe the reason for Signature's closure was due to the extraordinary events that happened on that day.
Mr. Roffler, same question.
Congressman, I don't believe the GAO report spoke to First Republic.
Well, to be clear, GAO's assessment clearly indicated that it was due to mismanagement of the two banks in particular. And I believe that if a bank fails due to misconduct and mismanagement, then executives should be held financially accountable. That's what the average person, the average worker, the average consumer has to deal with when they make decisions. So out of curiosity, Mr. Becker, did you receive a compensation package after your departure from Silicon Valley Bank upon its failure? And if so, do you mind disclosing how much?
After I was terminated on March 12th, I did not receive a compensation package.
Mr. Roffler, did you receive a compensation package after your departure from First Republic Bank upon its failure? And if so, do you mind disclosing how much?
I have not received a compensation package following the closure of First Republic.
Mr. Shea, same question.
No.
So let me ask a different question. Should bad behavior or poor judgment or terrible managing be financially awarded? I think absolutely not. And while we continue to hear very concerning reports that executives are taking huge payouts as banks fail, I am left to wonder, as many of my constituents are, if your compensation packages incentivized this crisis in the first place. And what's so frustrating to me and a lot of my colleagues about all of this is somehow that you feel as if you shouldn't be held accountable. Meanwhile, hardworking Nevadans and Americans across the country are held to higher standards of accountability in the work that they do each and every day. If an ordinary American took out more money in their account than what was actually available, then they would be charged an overdraft fee. If an ordinary American was one day late paying a credit card bill, they would be charged a late fee. Yet when a bank executive poorly manages their bank, which eventually fails, they are paid multi-millions. This is what's wrong, this is what's broken, and it must be fixed.
Gentleman's time has expired. The gentleman from South Carolina, Mr. Norman, is recognized.
Mr. Becker, I think earlier you mentioned you'd been in banking for 30 years, 12 of those as CEO.
Yes.
Mr. Shea, how long have you been in banking? How long have you been in the banking arena? Cut your mic on. I know you were director, but how long have you been in the banking sector? How many years?
Oh, how many? Since about 30 years,
30 years.
or 30 or more years.
Mr. Ruff, how long have you been involved in the banking arena? Been employed as a banker?
I've been at First Republic employed for 13 years, and before that I was with KPMG.
For how long?
16 years.
Okay. All of you have seen ups and downs in the market. Any of us, and I'm in the real estate world, development world, it's ups and downs. Mr. Becker, I find it hard to believe that, and your company grew from, I think, 40 billion up to 210 billion. I find it hard to believe that, particularly with the camel ratings that y'all had received and the warnings, that whether it's an MOU in writing or you described it in words, that it really wasn't an MOU, it was more of a conversation, that to not hedge your bets on the deposits, 94% were uninsured. How did you reason with that? How did you come to that conclusion? I know it paid higher returns, but was that, with 94% of your deposits being above the 250,000, how did you rationalize that?
Congressman, that was our business model that, again, my entire history, we had commercial clients and technology and life science clients, and they tend to have higher levels of deposits. That was our strategy.
But you took their money and you put it in an asset that you took, according to my what I have, you had 21 billion in securities. You sold at a $1.8 billion loss. Is that correct?
On March 8th, we contemplated raising additional capital and selling our available-for-sale securities portfolio, as I articulated in my written testimony.
Okay, and you mentioned, y'all were without a risk officer for 8 months. You've got 2,000, roughly a little over 2,000 employees. Did you happen to have a credit analyst or a financial analyst or a fund manager in that 2,000 employee number?
Congressman, to clarify, we had over 8,000 employees, and we had roughly 1,000 employees that had the majority or all of their responsibilities in risk management.
And nobody questioned what you were doing with the funds?
Congressman, the investments that were made in 2021 by our Treasury team and overseen by our Asset Liability Committee were invested in government securities.
Okay. Wasn't a good decision, was it?
Congressman, the decision that was made, I believe, was in the best interest with the facts that they had at that time.
Okay. Let me ask the question a little bit differently. I know my friend on the other side mentioned compensation. Were bonuses paid out in the last month of or close to the time that the feds took over?
The 2022 incentive compensation payments, as determined.
Bonuses. Were bonuses paid out?
Bonuses, incentive compensation payments were determined at the beginning of the year and paid out on March, I believe, 9th. Then that date was determined by our HR department and our finance team earlier in the year. That date was not changed.
But were the bonuses paid out after you had notice of the problems that you had at Silicon?
Congressman, the findings that we had, the regulatory findings, we were responsive to. And
I'm talking, were the bonuses paid out after you knew after you'd gotten notice the bank had some serious problems?
Congressman, the feedback that
It's
we
yes or
received-
no. You know the dates. It's yes or no. Were y'all aware that you were in serious trouble, and were the bonuses paid out? And what amounts were paid out?
Congressman, I respectfully disagree with the comment that at that point, the feedback we were in healthy shape. It was the
No, I'm sorry,
social media-led
Okay,
run.
on date-wise, and I got 10 seconds, were the bonuses paid out after you had notice, you were put on a notice that you had a problem with the bank? Yes or no?
Congressman, I don't know
That's
the
a no.
definition of,
You know I yield back.
The witness can answer on the record in writing. The gentlewoman from Michigan, Ms. Tlaib, is now recognized.
Thank you so much. And I really appreciate my colleague from North Carolina, because I think this is going to help answer the question that you refused to answer, Mr. Becker. If you look at the screen, you look at the slide there, it's pretty clear. Just so we're clear, because I know you're blaming social media. You're actually somebody that's blaming. You're not looking at me, Mr. Becker. I'm right here. You're blaming social media for your mismanagement and so forth, which to me clearly looks like greed. Because you're not stupid. You're just being greedy because you wanted to get a payout. Just so we're clear for the record, were you aware of any material or non-public information such as the potential capital raise before January 6th trading plan change that allowed you to sell over $3 million in stock, in Silicon Valley Bank stock?
when the plan was set up, I was not aware.
On January 26th, you changed a corporate trading plan, allowing the future sale of your shares in the company, correct?
On that date,
January 26th.
I filed a 10b5-1 plan that was signed off on by our legal team.
Okay,
Based on-
so it's yes, yes. So again, the question, were you aware of any material, non-public information, such as the potential capital raise before January 6th trading plan change that allowed you to sell over $3 million in Silicon Valley Bank stock?
When that plan was set up, I was not aware of the plan to raise capital.
So, Mr. Becker, given the federal funds rate increased more than 3% points during 2022, why did your company unwind these swaps, exposing your firm to further rate increases? Because everybody wants to know the answer to the why.
Congressman, as mentioned earlier, the decision around our interest rate hedges was made or overseen by our Asset Liability Committee and executed by our Treasury team.
Given the interest rates continue to rise, under your leadership, until the collapse, did you feel that terminating these swaps were safe and sound practice?
Congresswoman, as mentioned, I was not involved in those
Yep,
decisions.
you didn't, and you still got paid? They paid you to not know any of this? Like, what did you do? As the lead person you're just like, I didn't know, I don't know. Like, you got millions of dollars to not know anything about your own bank? Given your incentive compensation plan, Mr. Becker, the Financial Times reported that the interest rate swap sales resulted in a gain of $500 million for Silicon Valley Bank in the first 2 quarters of 2022 alone. Given your incentive compensation plan and other forms of pay, did you benefit from terminating its hedges against interest rates?
Congresswoman, if I could clarify 2 points.
Did you get money for it? Did you benefit from that decision?
Congresswoman, can I clarify the point that you're making?
Sure.
So
on the
the hedges are, when hedges are changed, sold, the benefit, if there is a benefit, it's actually amortized over several years. That was not taken into income that period of time. And secondly, our compensation committee would actually review anything that they believed was an anomaly outside of our standard practices and back that out typically from incentive compensation.
But Mr. Becker, do you think selling the hedges to interest rate risk is ultimately good for your depositors, shareholders, and other financials in our own financial system in the country as a whole? Was it just good for you, or was it for the executives at Silicon Valley that benefit from the sales through your incentive-based compensation? Because according to this timeline, it looked like you set it up so you all benefit and walked away, while every other bank in our financial system was literally like at jeopardy.
Congresswoman, our compensation was set up for long-term incentives.
You knew. You knew. You knew a couple years. Even if we increase regulation, they sent you notices. They met with you guys. What do you want them to do? Come arrest you and so you can respond to the fact that they saw that you guys were making really, really terrible terrible decisions. I love that GAO calls it poor governance and mismanagement. You were awful at your job, obviously, right? But at the end, you benefited while the small business community in the country hurt. You know what that looks like when I go back to my community and they're like wondering why we can't claw back the fact that you benefited while everybody else suffered. Do you care that you even would have collapsed the financial system in our country with your greed?
Gentlewoman's time has expired. Next, we'll go to the gentleman from Tennessee, Mr. Ogles. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here. I'm sure you're aware, or if you're not, we had the FDIC and the Federal Reserve, amongst others, in here yesterday. And although they acknowledge that they probably could or should have done more, they point the finger at you and your failings and your management. So, Mr. Becker, how forceful was the Fed in emphasizing the heightened interest rate risk that resulted from the shift from the COVID era's quantitative easing to an environment with rapidly increasing interest rates?
Congressman, the Federal Reserve was, we covered a lot of different areas. So we were responsive to the feedback that we received, including areas around liquidity, governance, controls, and the MRIA or MRA that we received with interest rate risk modeling.
Well, the reason why I bring that up is because from the start of the pandemic to when SVB collapsed, the Fed didn't mention interest rate risk in any of its reports to Congress. Were you aware that the Federal Reserve had to suspend its remittances to the Treasury last October because it took similar losses to you or your bank?
I was not aware of that, Congressman.
Well, I find it curious that the Federal Reserve, having experienced its own losses, did not recognize or realize the 5-alarm fire it had created. Mr. Shea, Mr. Roffler, how forceful was the FDIC in emphasizing interest rate risks as the priority in the supervision of your banks? Mr. Shea?
I only met with, I met with the regulators as chairman of the board, so I can't speak for their communications, all of their communications with the bank.
Ruffler.
Maybe just a couple of points. First of all, I think in Chairman Groomer's written testimony yesterday, he commented that the failure of First Republic was largely contagion effect driven, and he did not speak to management. I would add that I know several of comments have made about Camel's ratings and things of that nature. That is kind of confidential supervisory information that has not been made public. I do think that the committee might be interested in that information and could make that request, I believe, of the FDIC in the state of California, which would shine a different picture as it pertains to First Republic. And lastly, I would say that, as I mentioned earlier, we had constant examinations. The FDIC in the state of California were on-premise regulators for 6 or 7 years. They looked at a variety of topics: credit risk, interest rate risk, liquidity risk. And when they provided supervisory recommendations, to the extent they did, management worked to address them in an extremely timely manner.
Yes, sir. Now, Mr. Becker, I understand, your comments earlier. You talked about your business model, which was, I guess compared to maybe community banks, had a riskier portfolio, if you will. But understanding that there was a shifting interest rate environment, why wasn't there more priority put on hedging against interest rates in the event, however unlikely it might occur, as part of your again, if you have a 401k, you're going to decide how much exposure you're going to want to market volatility versus against your fiduciary responsibility. And of course, part of this is perspective, but when I look at some of the wokeism that had kind of swept into SVB, it seems like, and again, this is perception, I'm not saying it's fact, is that there was more focus on being woke than there was your fiduciary responsibility. And when I look at your exposure, when I look at the fact that in Econ 101, when the government puts more money into the economy can produce, there's going to be inflation risk on the backside. You don't have to be an economist to understand that. Anyone who's experienced in the markets is going to know there's going to be an upside risk there of inflation, and yet your bank, and again, the Fed and the Federal Reserve are pointing the finger at you guys, are saying that you should have done more. Why wasn't the main focus and priority as you move forward?
Congressman, 2 points. One is, I think it's important to note that the structure of our balance sheet, especially on the asset side, the loan portfolio was 90% variable rate, meaning as rates went up, we would have benefited from higher rates. So,
and if I may, I am out of time. I want to thank you all for being here. If you wouldn't mind submitting your answer in writing. And Mr. Chairman, I'm out of time. I yield back. Thank you. Thank you, gentlemen.
Mr. Chair, I have a
It's expired.
parliamentary inquiry.
Ranking member is recognized for your inquiry.
Thank you very much. My understanding is that joint subcommittee hearings are not contemplated anywhere in the House or committee rules, and therefore can only happen with unanimous consent. Can you confirm that this is your understanding?
It is.
Thank you. So I wish to share with you that I've made clear my concerns about this hearing happening at the subcommittee level to Chair McHenry, because it is very important for all of the members of this committee to have the opportunity to participate in a hearing like this. And I want to be clear that although I have withheld my objections this time, going forward, we will not hesitate to object if this kind of coordination does not occur in advance. Thank you. With that, I yield back.
So responding to the ranking member, I would say the chair and the ranking member both called for this hearing on March 29th. The first time the Federal Reserve and the FDIC testified before the committee. In your opening remarks, the ranking member stated, we also need answers from the CEOs who not only ran these banks into the ground, but enriched themselves. Separately,
Mr. Chair,
well, separately, let me, if
that
I
is
could-
not correct.
Can I just-
I asked for a hearing of the full committee,
Okay,
not
can I-
at the subcommittee level. Make that clear.
Very good. Separately, I would just remind the ranking member that on May 3rd, that you wrote to the chairman asking him to immediately schedule and invite the CEOs in the SVB, Signature, and First Republic execs to testify. This hearing responds to those requests, which was noticed last week pursuant to committee rules.
At the full committee level,
And I
Mr.
would,
Chair.
and I would also just add that if there is concern, the full committee is not holding this hearing. There shouldn't be, because the chairman of the full committee empowered the two subcommittees with the most experience in banking issues and conducting oversight, that the financial institutions and the monetary policy subcommittee and the oversight and investigation subcommittee were allowed to hold this hearing. So in fact, the chairman told the subcommittee chairs at the beginning of this Congress he wanted the bulk of this committee's work to be done at the subcommittee level. To that point, since March 10th, both Mr. Huizinga and I, the chairman, have sent 8 letters to state and federal regulators as well as the IG.
Mr. Chair, in a continuation of my parliamentary inquiry, you must admit, and I think the chair will admit, that my request for holding this hearing was at the full committee level. And of course, you're not implying that the expertise does not exist at the full committee level when you identify that it has been held at the subcommittee level because of the expertise. Mr. Chair, I'm finished with it, and I said to you that despite the fact I did not object this time, I will not allow it to happen again without objecting. I yield back.
Thank you for yielding back. I think a conversation with Chairman McHenry would be valuable. And now we're going to recognize the lady from Texas, Ms. Garcia. Are you ready? Okay, you're yielding?
No, she does not have to yield. As a matter of fact, my time, I am next to be recognized. And the inquiry was just a preliminary to my time to raise the question.
Okay, the ranking member is recognized for 5 minutes.
Thank you very much, Mr. Chair. So, I am interested in learning about all the factors, including bank mismanagement, lobbying efforts to deregulate, and other decisions these executives made that put their customers and our nation's banking system in harm's way. The leadership of these banks must be held accountable for running their banks into the ground. Mr. Becker, it is a fact that your bank experienced rapid growth, doubling in size from 2018 to 2020, and doubling in size again in 2021 alone. Earlier today, in questioning, you suggested that the regulators never discussed the issue of interest rates with you. However, you later acknowledged that the bank was subject to investigations regarding its handling of interest rate risk, and it was cited by the regulators as a problem. In fact, as early as 2018, the Fed had begun citing your bank for poor risk management, including interest rate risk. 4 months before your bank failed in November 2022, the Fed further issued an MRA on interest rate risk. This MRA would have been issued to the bank's board. Is that correct? It would have been issued to the bank's board.
Congresswoman, the regulatory findings are typically issued to management.
Thank you very much. Can you confirm you were on the bank's board November 22?
Yes, I was.
Okay, then you did have access to all of that information. Thank you. So you would have personally received this MRA and all other MRAs and would have had an understanding of interest rate risk, and to say otherwise seems highly misleading. So to me, it looks like you did know what was wrong. I'm also concerned that after the earnings call, with investors on January 19th of this year, you amended a 10B-5 plan to sell approximately 12,451 shares of SVB. These shares were sold 2 weeks before you drove the bank into the ground, and you received $3.6 million. Other shareholders in SVB received nothing when the bank failed. Mr. Banker, how is this not a golden parachute you secured for yourself as the bank was failing?
Congresswoman, that sale was part of a 10b5-1 plan that was issued right after our earnings release, reviewed by our legal team, and with my concurrence that I didn't have material non-public information. When SVB was taken over by the FDIC on March 10th, I lost 5 times the minimum shares that I was required to hold.
Thank you very much. We have a different opinion about that. I'm going to go to Mr. Shea. You ran one of the well-known crypto banks after Silicon Valley Bank suddenly failed. The market viewed your bank as the weakest link, and depositors quickly began to pull their money. 2 days later, your bank closed. Now, according to the bank failure reports we have received, it seems like your bank didn't even know what collateral it had available that would be eligible to pledge to the Fed in order to obtain emergency loans. Was this the case? Why didn't you know what collateral you had?
My role as chairman, I thought we had collateral available. I thought we had collateral available that was pledged at Federal Home Loan Bank and Federal.
Why did you not understand what assets your bank had to pledge is the question, and you didn't. Mr. Wofford, J.P. Morgan Chase and 10 other big banks deposited $30 billion in your bank after SVB and Signature Bank failed to rescue your bank. However, in a matter of weeks, your bank failed. What amount would have been sufficient to save the bank? That was $30 billion that 11 banks came together and gave you. What did you need further after that?
We were appreciative of those 11 banks who were helping to reinforce confidence in the regional banking system, which is such an important part of the economy. Unfortunately, First Republic was hit by the contagion of 2 failures that were occurring, and when the contagion spread to us, it's hard to recover confidence. And by the end of April, investor and depositor confidence had not returned, not for management's efforts and not for everything we did. And again, we had very open and very direct communication.
Thank you. My time is over, but no amount of money would have saved your bank. It was mismanagement that caused it to fail. I yield back the balance of it.
Ranking member yields back. I will now recognize myself for 5 minutes. Vice Chair Barr expressed a desire to assess how the Federal Reserve performs analysis on bank mergers. This follows President Biden's call for DOJ and the agencies responsible for banking to update guidelines on banking mergers to provide more robust scrutiny of the mergers. We strongly believe antitrust analysis should be governed by the rule of law and not by the individual views of those who, at any particular point in time, head the relevant agencies. So, I'm concerned any change to that analysis that would depart from long existing and widely accepted standards may not reflect actual changes in the competitive environment. A functioning bank system must allow stronger regional banks to be able to acquire those in a weaker position. Mr. Becker, do you believe the current hostile environment towards mergers played a role in your bank's failure?
Congressman, that's not an area of expertise that I have, so I don't know the answer to that question.
Mr. Shea, would you like to respond to that?
I don't think the regulatory merger policy had anything to do with what happened to Signature Bank. I thought we were in a position to continue after the March 12th, March 13th. I thought we had a plan in place, a well-reasoned, solid plan in place that would have brought Signature Bank to exist today and continue to serve its customers without any merger from anyone.
Very good. A November 11th, 2022 Wall Street Journal article explained at length interest rate risks presented to the banking system by the Fed's inflation-fighting rapid increase in interest rates, kind of an article that's been referred to hundreds of times now in this committee. Silicon Valley Bank was mentioned as a particular case with, as of September 30th of 2022, a market value of its held to maturity bonds just slightly above the value of its total equity. So clearly, regulators should have been becoming aware of the risks surrounding Silicon Valley Bank. So back to you, Mr. Becker, if the uninsured depositors had not forced the bank to close with this mini rush, how much longer do you believe the regulators would have allowed Silicon Valley to continue before intervening at all?
Congressman, I don't know what the regulators would have done. I can't speak for them.
Well, let me ask it a little bit different way. Were you working in concert with them, with the regulators, and was there a back and forth with the regulators that would have maybe laid out the case that there are some serious issues emerging related to Silicon Valley Bank?
Congressman, as stated in my written testimony, we were very responsive to the regulatory feedback. Regulators at the FDIC and the Fed and the state.
Okay. The issues with SVB were pretty well known in the days leading up to the failure, right? However, Signature's failure came as a surprise announcement. So to Mr. Shea, at what point was it clear to you that Signature Bank could not last without some type of intervention?
I believed that they had Signature Bank on Friday was sufficiently capitalized. It was well solvent, well diversified. It had a strong securities portfolio and had $29 billion pledged at the Federal Home Loan Bank and Federal Reserve. I fully expected Signature Bank to continue on, and I fully thought that the plan that was presented for financing against good collateral at Signature Bank would have allowed it to continue open successfully on Monday and be still serving its customers, its middle market customers, its customers today.
I will yield back my time and at this time recognize the gentlewoman from Texas, Ms. Garcia. 5 minutes.
Thank you, Mr. Chair, and thank you to the witnesses today. I know we've been talking about trying to have this hearing. Democrats have kept constantly been asking Republicans to bring you down here, and I'm glad you're here, and I'm glad you cooperated and are here with us today. Because it's time for accountability. Republicans have been pointing fingers at regulators, but we finally have a chance now to visit with you about your internal workings and your leadership on these failed banks. First, I want to get into some lobbying questions here. Mr. Becker, in 2015, you had lobbied Congress to raise the asset threshold for banks that were considered systematically important. Years later, in 2018, the former twice impeached president had signed S-2155, the Economic Regulatory Relief and Consumer Protection Act, into law, which raised the threshold from $250 to $250 billion, an increase from the previous $50 billion. By this time, Silicon Valley Bank had just reached $50 billion in assets and quickly grew so that by 2022, as been stated earlier, the bank held more than $200 billion in assets. The passage of this law and the way Trump's regulators implemented the law reduced stress, testing, liquidity, and other requirements for banks like Silicon Valley Bank. Mr. Becker, was that your intended goal when you urged Congress to roll back Dodd-Frank's enhanced prudential standards for regional banks, or is it just a coincidence that it was regional banks like yours that failed in rapid succession earlier this year?
Congresswoman, the written testimony that I provided in 2015 was focused on tailored regulation. And what we wanted to do is empower the regulators to make the decisions about risk and be able to then tailor those regulations based on their assessment of the risk profile.
So you don't think that this was just a coincidence as it happened to help your bank and your bank grew as a result of the change in regulations?
Congresswoman, Silicon Valley Bank in 2015 was one of many banks and other institutions or organizations that were talking about tailored regulations.
Okay. Mr. Ruffalo, let's talk about First Republic banks. Reportedly, you spent significant sums lobbying Congress under your leadership. In 2018, First Republic spent $370,000 on lobbying. This was reportedly some of the highest lobbying spending in the bank's history. Do you recall what congressional business or legislation might have been of interest to First Republic in 2018?
Thank you, Congresswoman. I was not the CEO at the time. I was at the bank. And there are two topics that came to mind. One is what you referenced before, S2155, and the other was around tax deductibility around student lending and contributions to student loan forgiveness or student loan repayment plans.
So were your paid lobbyists urging Congress to roll back the Dodd-Frank enhanced prudential standards for regional banks?
I believe they were speaking with Congress about the tailoring rules, as one of the panelists mentioned. And at that time, as I mentioned, I was not the CEO, so I'm not entirely familiar with all of the
Were you
communications.
at the bank at all?
Excuse me?
Were you at the bank at all?
I was, yes.
So were you not privy to any of the discussions about your lobbying efforts?
Not always, no.
Not always. But it seems to me that you all were lobbying for the changes that may have resulted in some of the failures. But thank you for that response. And now, Mr. Becker, the Federal Reserve stated that it issued multiple supervisory issues to Silicon Valley Bank, including matters requiring attention, and we've talked about those MRAs, and matters requiring immediate attention, MRIAs, which are typically considered to be more urgent issues. Mr. Becker, why didn't the bank take these warnings by the Federal Reserve seriously?
Congresswoman, I can assure you that we took all regulatory findings seriously, regardless of whether they were MRAs or MRIAs.
Well, you might be interested in knowing that when we had the GAO director here, he actually said that many times you all, quote, responded by saying that it would take a while to fix a problem, end quote. What's your response to that? That their analysis was that you all took your time about fixing anything?
So, Congresswoman, it depends upon what regulatory finding it would be. So some of the matters around liquidity were handled very quickly. Others that took systems changes took longer.
The gentlelady's time has expired.
Thank you, Mr. Chairman.
The gentlewoman from Texas, Mrs. De La Cruz, is now recognized.
Thank you, Chairman Barr, for holding this joint hearing today. It's important for all of us to talk about what happened, what kind of oversight needs to be done moving forward, if so, and what led up to these banks failing, and how the responders, how the regulators responded. With that said, I would like to thank the witnesses for coming today. I'm towards the end, and so I want to tell you a little bit about my district. I'm from South Texas. It is largely a Hispanic district, in fact, one of the most Hispanic districts in the entire nation. That being said, we have a large rural community that really depends on regional and small banks. And so as I call the banks in my area when this was happening, they were worried about bearing the consequences of your bank failures and what that may mean for them in the future. And so with that being said, our friends on the other side of the aisle have called for higher capital requirements and increased regulations due to your bank's failures. What I would like to know from each of you is, do you think that increased regulation and or increased capital would have prevented this crisis? And I'll start with you, Mr. Becker.
Congresswoman, as I laid out in my written testimony, we're here today, from my standpoint, because of a series of unprecedented events. As far as what are the rules and regulations that could have prevented it, I don't have the answer to that, but I'm hoping my testimony and the other testimony will help us get there.
Signature Bank was well-capitalized, solvent, and well-diversified at the very end. and had a plan to go forward that I sincerely wish had happened, because I believe we would have been here today. But in response to your question, on that afternoon, in those few hours in the afternoon, in the late afternoon of Friday, depositors who I spoke to simply wanted to get their money in a too-big-to-fail bank. They said they didn't care if there was a 1 in a million chance. They didn't care if there's a 1 in 10 million chance. This was their family money, their family business, their way to make payroll. They couldn't take any chance of not being in a too-big-to-fail bank. And they said things like, J.P. Morgan they won't let J.P. Morgan fail. I know they'll save Citibank. And so I don't know what I don't know, but I know that's the challenge.
Yes, sir.
Thank you for the question, Congresswoman. I want to be very clear that I can't speak to what has happened at the couple banks here with us today. But what I can say is that what happened at First Republic was not mismanagement. It was element of contagion. And if you think towards the regulatory side of that, when contagion hits, it's very hard to regulate and call for greater capital, greater liquidity. As I said earlier, we had very strong relationships with our regulators. We shared everything. We met all the time. And we had zero matter requiring board attention at March 9th when the contagion moved towards First Republic. And so I think, to your question, it's very important for the communities that are served to have appropriate regulation to keep them safe and sound, but allow them to serve their clients each and every day.
So that being said, given you all's expertise in banking, how do you think smaller financial institutions, community banks, would be able to cope with increased regulatory burdens?
I think it's a great question and not one I probably have a great answer for, but I think if policymakers and regulators, invite comment and engagement, I think it's probably the best way to try to do that, and hopefully those banks will engage in that discussion.
Thank you, Mr. Shea.
I would defer to banks who are of that asset size.
Okay. Mr. Becker?
Yeah, I would agree that's something that this committee should pay attention to.
Thank you. And I'm going to ask real quickly, because of what we saw happen, do you all have any suggestions for Congress on how to address the technology of this that we've talked about for so many hours now? Could we do something different on the social media side or address something different? Anybody like to take it? All right, I yield back.
Gentlelady's time has expired, and the gentlewoman from California, Mrs. Kim, is now recognized.
Thank you, Chairman. I want to thank the chairs and ranking members of this committee for having a joint subcommittee hearing. Since SVB's failure, our committee has been laser-focused on getting complete information and helping to prevent similar bank failures from occurring in the future. And there are two main points that stand out from the postmortem reports, and that is bank mismanagement and supervisory failures. Mr. Becker, while I agree with you that the Fed and Treasury Department missed the mark by describing inflation as a transitory risk, I am surprised that you decided to drop most of the interest rate hedges by mid-2022. And this is after the Fed started to increase rates in March 2022. In SVB, by then we already know, we had 31 open supervisory findings and did not have a chief risk officer for most of last year in 2022. So, Mr. Becker, yesterday, you also mentioned that the specific decisions about hedges were executed by the Treasury team. But as CEO, didn't you have the final say on the decision that was executed by SVB's Treasury team?
Congresswoman, the decision on the hedges, I was not privy to. They wouldn't have come to me for approval.
You know, the Wall Street Journal reported you reduced hedges to $563 million. That is down from $15.3 billion just a year earlier.
Congresswoman, as I mentioned, I wasn't part of the Asset Liability Committee, and I have every reason to believe they made the best decisions they could with the information they had at that time.
Do you believe then not having a CRO played a role in the decision to drop the hedges?
To the best of my knowledge, I don't believe so.
Well, Mr. Becker, in early 2023, March of 2023, you sold your available for sale securities at a $1.8 billion loss. You didn't have an immediate need for liquidity, and this sale had a negative impact on your regulatory capital. So why did you make that decision?
Congressman, that decision was made in consultation with our board of directors and outside advisors, and we believe that was the best decision for our clients and for our shareholders.
Those securities were sold to Goldman Sachs, the same investment banking firm that was advising and underwriting your capital raise. So didn't this seem like a conflict of interest? And how did you ensure that you received the best possible price for those securities?
Congressman, Goldman Sachs was our advisor on our capital raise, and the decision to ultimately sell the AFS portfolio to Goldman Sachs was a decision that was reviewed with the board of directors and the special committee of the board. To my memory, they put in place a structure that would be a benefit such that it was to get the best price we could and then validate that in the market.
Okay, well, we're going to move on. Mr. Roeffler, let me ask you a question. The unprecedented speed of withdrawals in the digital era is pushing our committee to rethink the rules, regulations, and the role of the Fed as the lender of last resort. And it's been reported that your firm was one of the banks that used both the 13(3) facility and discount window. Did these lenders of last resort meet your liquidity needs in March? And in your view, what could have been improved?
Oh, thank you for the question, Congresswoman. Yes, beginning on March 10th, we began to engage with the Federal Reserve Bank of San Francisco and also the Federal Home Loan Bank. We had previously pledged collateral with both of those institutions that we could borrow from. And during the weekend, when the contagion spread to us on that Friday, we continued to prepare that weekend, and actually the Federal Reserve Bank worked with us to ensure our collateral was pledged and we could appropriately access it. And that Monday, we accessed it with no challenge.
Well, thank you. I'm going to come back to you, Mr. Becker. So how many years did you serve on the board of directors at San Francisco Fed?
I believe it was roughly a little more than 4 years.
So as a board of director, did you at any point have any input on the supervisory activities of the San Francisco and any financial institutions, including SVB?
I did not.
Well, could you walk us through the role that you do as a board of director at the San Francisco Fed?
The gentlelady's time has expired, and the witness can submit an answer in writing to that question.
Thank you.
I'd like to thank our first panel of witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to these witnesses to the chair, which will be forwarded to the witnesses for the response. I would ask that each of you please respond as promptly as you are able. The committee will take a brief recess to let the first panel go and seat the second panel. These witnesses are now dismissed. The committee will stand in recess.